Hi, Nick Colos from DataTrek here, and the topic of this video is how U.S. and global stocks have done year to date. We're filming this at the right middle of the first quarter, and we look at performance data for our clients on a monthly and mid-quarter basis religiously, and there's a couple of reasons for that. The first one is this is how the big money actually looks at the world. This is what they think about. This is what they look at to understand where money is flowing across a quarter, across a year, across multiple years. Performance is everything. And that's why they look at the data. And we'll review, I think, at the high level, what they look at to understand what's going on right now. The second reason is looking at this data really gives you a strong sense of the market narratives currently pushing around stock prices around the world. So what's the effect of interest rates on risk appetites? What's mean reversion doing to equity valuations by sector and by region and by country? And then lastly, what's investor sentiment like? Where are they looking for returns? Where are they looking to put money to work? Where have they put money to work? And what's fascinating to me is that the first quarter of 2025 so far is really a textbook case study in all three of those things, all three of those reasons. We should be looking at this data very consistently and rigorously to understand what's going on. So with that, let's kick off the discussion and look at what's happened in U.S. and global equity returns since the start of the bull market at the beginning of 2023. And I think it's a really fascinating story. If you look at 2023 returns, you had a lift off the lows in October of 22, and for the first full year of the bull market, it was an all U.S. stock rally. So if you look at the S&P up 24% in 2023, led by tech stocks, the NASDAQ up 43%, the Russell doing a little okay, 15%, not the usual lift off the bottom, but at the same time pretty respectable. But what's interesting is that rest of world just didn't do as well as the S&P or the NASDAQ. Rest of world stocks were up 12%, with Europe up 16, Japan up 18, and emerging markets kind of lagging at 6. 2024 was going pretty well. Honestly, I didn't put the numbers up, but you can see that Q4 is really where things fell apart. And if you look at Q4 of last year, the S&P was up 2%, the NASDAQ was up 6%, very much like that 2023 kind of return, but non-U.S. stocks just got destroyed. Non-U.S. in aggregate was down 9%, Europe was down 11%, Japan was down 6%, and EM was down 9%, all in 90 days in Q4. And we'll get into a discussion about what happened there in a second. But I just want to point you to the fact that 2024 ended up being a great year for the S&P, up 23%, for the NASDAQ, up 29%, rest of world for the whole year only up 2%. Europe was actually down 2%, and Japan and EM were up 5% and 4% respectively. And then we come to 2025 and what's happened so far in the first half of the first quarter. And it's fascinating because now you have this big bounce back going on in non-U.S. stocks, up 7% year to date, beating the S&P up 4%, beating the NASDAQ up 3.7%. And it's really being led by Europe, up 10.7, almost 11%, with Japan only up 3 and emerging markets up 6. So clawing back some of those losses. But if you look at the comparison of Q4 of last year to the year to date, you see an almost mirror image of what's gone on last quarter and so far this quarter. And that theme plays out if we look at U.S. large cap sector returns. And I've put up the data here for the same time series as the chart we just were looking at. And if you look at 2023, the lift off the bottom from the lows in October 22, S&P as a whole does great, up 24%. Technology leads the way, 55% gain. Comm services, 51. Consumer discretionary up 38. Those are very tech-heavy sectors because Meta and Google are in communications. And you have Amazon and Tesla and consumer discretionary. No other sector outperformed. A couple were even in the red. Consumer staples, utilities, energy didn't have a great 23, even though there was a big bull market in stocks. Again, moving into 2024, Q4 was pretty tough. Tech did fine, consumer discretionary especially because of Tesla being in that sector, and comm services because of Meta doing quite well. But in general, pretty tough quarter. Overall, just up 2%. But look at the returns for the non-tech sectors. You're looking at losses of 13% for materials, 11% for healthcare, 6% for utilities, 2% for, 6% for utilities, 2% for energy. Just a disaster of a quarter. And if you now fast forward to the first half of 2025, just like the first table we looked at, you see there's been a big bounce back in the non-tech sectors. Only comm services has done well, mostly because of Meta, which is having a fantastic year. The rest of the tech-heavy groups not outperforming, but industrials up 4, materials up 7, financials ripping along, still up 7. And then you've got healthcare up 5, utilities up 5, energy up 5, really strong performances. But again, look at the bounce back they've had. They had a horrible Q4. They're having a great 2025 so far. So do we call that, quote, a rally in non-tech? Probably. That's fair. But we also have to put it in context. Those gains that we're seeing this year really are a snapback from the losses that we saw in Q4. It's kind of a reversion to the mean in terms of valuation and investor sentiment. So wrapping this up, a couple of takeaways that I think are super important. The first is that 10-year Treasury yields continue to be the single most important thing to look at in terms of understanding global equity markets. In Q4, yields went up very quickly. Even though the Fed was cutting rates, 10-year yields rose because the U.S. economy is still doing quite well. Went from 3.8% at the start of Q4 to 4.6% at the end of the quarter. And that was a big signal to global markets that if interest rates are going up in the U.S., the risk of U.S. and global recession tends to rise because interest rates, if they get too high, can really clamp down on economic growth. That's why you saw those non-U.S. sectors underperform. That's why you saw all the cyclical sectors underperform except for financials. But Q1 to date, very different story. Rates are stable. Started the year at 4.6%. Now they're 4.5%. And there's been a nice global risk-on trade, and we saw that in the data. Now, just taking a step back, 5% is a very important number for 10-year Treasury yields because every time over the last 20-plus years they hit 5%, they very quickly pull back in. They haven't really been above 5% for more than a week or 2 or 3 in over 2 decades. Markets simply don't know how to think about that 5% level if we break it and go above it. And that's why they get very twitchy as yields rise towards 5. Now, as far as what's going to happen over the rest of the year, we're thinking it's going to stay between 4.5% and 5% in terms of 10-year yields. You've got inflation worries, deficit worries, policy uncertainty, and so there's no real reason for that 10-year yield to come down very quickly unless we get a big exogenous shock that makes investors reconsider global growth, but we don't see that happening. And so we think 10-year yields stay in this band for at least the first half of the year and into the back half of the year. The second thing I think is very important to think about is that 2025 year-to-date is not so much about a big rotation into non-U.S. stocks. It is much more about a relief rally that 10-year Treasury yields have come back down again. And if you keep in mind the fact that the S&P is up 22% over the last year, but Europe is only up 10, Japan is about the same, and emerging markets are up 12, then you realize there's been a big performance gap between the major geographic areas. And as a result, this sort of quarter-to-date performance is really more emblematic of some simple reversion to the mean, not so much a big rediscovery of non-U.S. stocks. We'll have to keep watching it going forward, but our view is that a lot of the gains that we've seen in rest of world stocks in the first half of the quarter are not going to be as strong in the second half of the quarter. We've seen the big reversion trade, and now it's going to be much more of a slog. So the gap between rest of world and U.S. stock returns should crunch down pretty tight in the back half of the quarter. We're not going to see the same kind of dramatic outperformance. As far as potential investment ideas, we still like financials, we still like industrials, we still like healthcare, and European equities are showing some very nice momentum. So if you're looking for a back half of the quarter trade, that's an area to look for because I think that area, European equities, developed Europe, are doing quite well. They're coming off a very low base, and with interest rates coming down in the region, possibly some interest from investors in playing more cyclical trades, particularly European financials. So those are some basic ideas to look at. I hope you enjoyed the video, and if you did, please do hit like and subscribe. If you're looking for more information about DataTrek, please check us out at datatrekresearch.com. And with that, thank you for watching, and I hope you have a great day. Thank you.